Hi all, I'm just introducing it. This is my new YouTube channel. It's the DIY Investing Guy. I'm Callum, and I'm going to be going through companies on my watch list that I'm going to be adding to my Freetrade portfolio in the next few weeks. I'm going to be starting this portfolio from scratch, so I'm going to be looking to invest between £100 and £400 a month into this portfolio and splitting it between 4 or 5 stocks. Can I just ask you all to subscribe to the channel to help the channel grow? And if you enjoy the content, like the video and hit the notification bell for future portfolio updates and company analysis. The first company on my watch list that I'm going to be doing first in the first episode is Moonpig, and I'm going to just go through my initial research into Moonpig and how I feel and what my conclusions are on this company. Obviously, once I've done 4 or 5 on my watch list, I'm going to decide what companies, the first month, which will start in April, are going to go into my portfolio, and then I'm going to just split the money between them 4 companies. I might put more into companies that I'm more bullish about than more speculative investments. Basically, with my free trade, it's not my main portfolio, but I'm just doing it so that I can buy and build positions in more high growth stock, higher risk equities and stocks. So today I'm going to be going through Moonpig, and obviously once we've done all the companies on my watch list, I'll start my free trade portfolio, and I'll be doing it weekly, maybe Monday or Tuesday every week, probably Monday after the weekend. I just want to go through Moonpig. Moonpig is an online retailer in personalised greeting cards. It also sells flowers and chocolates, but its main source of revenue is personalised greeting cards. A bit of background on the company. Nick Jenkins founded this online personalised greeting card business only 4 months after the market crash, when all online businesses were going to market. Anything with .com in there in the early 2000s and late 1990s. Was just going in there. With anything with web or .com in there was going in there. Wasn't even a good business, just to do with the online, and then the market crashed. He obviously didn't have the rush to market mentality of most online businesses of that time, and he chose to ensure the company had a robust business model first, with a durable competitive advantage, which Warren Buffett, a famous investor, would call the moat. What separates it from the competition and gives it durable competitive advantage over the long term. He only listed the company 2 decades after he founded it, and that was this year on February 2nd, 2021. And now that's basically the outline of the business. Obviously over time it's developed as well, because when it first started, you'd have to order on your computer, go on the internet, upload the photos, send the photos into Moonpig, and wait for them to come to you. Now everyone can just send pictures from their phones, and it's pretty much, you send it in, you order your card, £3, comes the next day, Bob's your uncle. It's amazing, good business. I'm just going to go through now the business model, and obviously it's durable competitive advantage. The product is not price sensitive, and that means obviously because it can charge its price, which £2.99 for a personalised card is okay, because it is a personalised product. It's not something you can just go into a card factory or any card shop in the UK and just buy a personalised card, have it the next day. So it's a premium product that isn't price sensitive. It's also got low capital expenditure, because it doesn't have to bulk up with stock and stuff. Obviously, as card manufacturers make the cards for them, there's several different card manufacturers that make the cards for them. So it doesn't make a card unless somebody orders a card. So if it's not ordered, it's not made. So it has low capital expenditure, and obviously with that it carries low levels of industry. Now most greeting card companies would have to carry a high volumes of stock. They have to get all the Mother's Day cards in early, prepare it, and they'd have to have all the inventory. And if they don't sell that through, they've got a lot of dead stock, and money just stuck in a pile of a warehouse somewhere or in a shop. Obviously it's personalised, which is the point of difference, and it can maintain these larger margins for over the long term. It can the cost of making a product, the cost that it's charging, that's the profit in between, and it can maintain large margins because it is a personalised product. And obviously, like I just spoke about, you manufacture it to demand. And obviously, as a company, it has a fraction of the labour cost of its competitors. For instance, like, you know, physical companies with physical stores like Card Factory and Clinton's and, you know, all these other companies of the past and Car Connections, they have to employ staff. Whereas Moonpig only has 75 employees, so, you know, it's a fraction of the labour cost. It's a relatively recession-proof company. You know, if you lost your job, you know, you might cut back on your subscriptions, your Netflix, your weekly shop might go from £100 to £50 a week, you know, stuff like that. But, you know, you're still going to buy your mother a Mother's Day card, still going to buy your children birthday cards, and, you know, you might not get a massive presents and, you know, stuff like that, but you will, you know, you're going to spend £2.99 on a card for them, aren't you? So, you know, especially personalised, it makes all the difference. Yeah, so that's the business model, really. It's a pretty good story, pretty good business model so far. I'm just going to go through the performance of it. There's not much data out on it. There's no PE ratios and stuff like that. But I'm just going to go through the basic broad highlights of what we've got so far. Obviously, there's no PE ratio and stuff like that because it's only just come to market. The revenue was increased by 44% to 173 million. You know, that's based on the last full results, which was up to April 2020. And I'm sure when the next lot of full year results with lockdowns and stuff, because it's an online business, it's and obviously its competitors have been closed, its 2021 full year results are going to be quite good as well. The revenue growth on average over the last few years is 13%, but, you know, considering the last revenue growth was 44%, that's good sign for to be quite bullish on this company. There is a lot of optimism around the IPO, which to me is a good sign that the company's done well during the COVID-19 lockdowns and the horrible 2020 that everyone's endured. I'll just quickly go through the IPO. It was valued at 1.2 billion on IPO and has rose as high as 29% in the early trading. The benefit is you can add it to your ISA if you want to add it to an ISA portfolio. You know, all your gains are tax-free over the long term. There's the risks involved at the moment are the fact, because it's just new to just freshly IPO'd, which I don't normally buy into IPOs, and I don't recommend buying into IPOs. I'd like to leave it, like, you know, 3 months at least, but maybe a year sometimes, because the price is that volatile. So the risks are the founders can sell some of the shares, which is offset by mom and pop investors like you and myself, and institutions buying it, basically. The share price can be very volatile. My conclusion is I believe that Moonpig is an amazing company with great term long growth perspectives. And from my personal experience, obviously, I use the products, Mother's Day cards. You know, it's in the thumbnail of this post. Those are actually the Mother's Day cards that I've brought and used. And from my personal experience, the best investments are products and services I use and understand. Basically, Warren Buffett and Charlie Munger would call that my circle of competence. One of my best stock picks of 2020 was Greg's. He's in my top 3, and I use that every day. Or you know, most days at lunch I'll go and buy a sandwich or a sausage roll, have a drink, and it's a great British company, food company. It's more of a fast food outlet now than a bakery. People go in and buy their, you know, savoury and sweet products. And I put quite a large portion of my portfolio into that stock last year, £4,000, and I had a return of £1,700. So, and basically I could sleep at night with that one because I understood the company. So it's best to understand the company, but you know, it's not a biotech. I don't have a clue what's going on with biotech or anything like that, so I don't invest in it. I will be building a position in this business over the course of 2021 in my Freetrade portfolio, and I might, you know, bed an ISA into my ISA portfolio in early 2020. So I just want to put a disclaimer out there. I'm not a financial advisor. I'm not advising whether you should buy or sell. This is my own personal opinion for my own personal portfolio. So please do your own research, DIY, like I said earlier. Obviously, I want to know what everyone else's thoughts are on Moonpig. It's new to the market. It's just recently IPO'd, and so if you want to drop a comment in the comment section, and I'm willing, I'll try and get back to everybody that drops a comment, and I'm up for a discussion on this particular company. I'm just going to ask you to subscribe and hit the like button if you've enjoyed the video. I'm just going to quickly have a quick look. So since it's IPO'd, it started at £4.50, and it's really just gone up and down. It's not really done anything. So I'm looking to start a position in this and dollar cost average my position over the course of the year in my Freetrade portfolio. And yeah, that's it really. It's not much to go on it at the moment. It hasn't been in the market very long. Yeah, so I hope you enjoyed this video. And I'll be doing another watchlist portfolio, Freetrade Portfolio watchlist company in the next week or so. Thank you. Have a nice day.